Emergency press conference. The Fed has dropped interest rates. Pandemonium in the streets. Emergency press conference. The Fed has dropped interest rates. Pandemonium in the streets. People jumping out of windows. All of Dad's listings are selling. I'm Jason Barlow, sell for 1%. Joined by my dad, Dave Barlow, and Rich Sircone with Equitable Mortgage. Give you guys a quick market update. It's Thursday, September 19th. Fed just moved rates. Big news. Everyone's been waiting for it. Rich, did rates go down?
Well, it's a very interesting day in interest rate land, folks. The Fed did lower rates a 0.5 point yesterday. And as we discussed, this was already anticipated. This was completely baked into all the numbers coming into yesterday's meeting, and the mortgage market totally expected that to happen. Had it not happened, we would have seen interest rates go flying up yesterday. But it did happen. They lowered rates a 0.5 point. So in reaction to that, what we have seen yesterday afternoon and now it's early Thursday morning, we haven't really seen the markets move that much and open yet. But what we are seeing temporarily, at least, is rates are about the same and maybe a little bit higher than they were yesterday at this time. The yield on loans is a little bit less profitable for a bank than they were yesterday. It's not that they can't give you the same rate, but they may have to charge you a little bit more closing costs for those rates. So as we've been telling the folks for a while now, at least 3-4 weeks, the Fed has already telegraphed that they're going to lower rates, and the markets are anticipating that. And mortgage rates went from 8% to low 6s and sometimes even high 5s over the last few weeks. Yeah. And at this point, there doesn't seem to be any more steam in the ship for them to continue to go down. I think it's going to be data dependent. What happens with numbers like the GDP and the CPI, the PPI, and the employment numbers, as we see those roll out into the end of this month and the beginning of next month, that will give us some indication of what the Fed will do next. And even though they have kind of said they're going to continue to lower rates, the market's not totally buying that. And so the answer is if you're looking for a 2% mortgage, that's not going to happen right now, maybe ever. But we are seeing low 6s, high 5s, and it's time to jump in if you need to buy a house. These are rates that are very good considering the historical number of rates. If you go back into the 80s all the way through 2024, a high 5, low 6 rate is a very attractive interest rate.
Yeah, I think over that 30-year period, the average rate's about 7.5% when you look at 30 years. So, you're well below that. It's just, we got spoiled, a couple, 3 years ago. I have a interest rate in the low 3s. And so I'm not going to sell and go take on a 6% interest rate, which is what a lot of sellers are talking about. I did hear an interesting conversation with Goldman Sachs, one of the guys there, and his thought was that once rates got below 6%, that their survey showed that there would be a pickup in the market. That in the 6s, and I always thought, well, if it came below 7, we should see a little, pump, and we didn't. And what he was talking about yesterday is that their surveys over the last couple of years have shown rates get down into the 5s is where we'll see the housing market start to really pick up because a lot of pent-up buyer frustration, and that is a perceived number that is tolerable versus, 7 and 8%, which is where we're coming from. Have you heard anything like that, Rich?
Yeah, well, anecdotally, just from my seat and just talking to people every day, I think that 5s will start to move people that really have a a underlying reason to want to move off of their 2 or 3% interest rate and get into a different home with a 5 or 6% interest rate. The low sixes, the high fives are enough to get people like that moving. They have an extra child. They need an extra bedroom. They need to buy a different house. And okay, we're not going to double up on bedrooms. We're going to go ahead and buy the house we need now. But I think that people who just casually maybe would like a more luxurious house than what they have, but don't need it, I don't think that those people, high fives, low sixes, are going to motivate them. I think we need low fives, fours to get those people off the hump. But we will see buyers come into the market now, I think, who need to buy because of school system. They have children going to school and they want to be in a certain school system, or they have more children, or or maybe they relocated to Columbus and they started renting and now maybe they'll buy. We're going to see things like that start to happen now, I believe.
I've seen some reports that, like, when all the craziness was happening from like 2020 through, when rates were down 3% or whatever, like 82%, I think was the number I saw, of home buyers who bought then have regrets over their purchase, but they can't move because of the golden handcuffs. What you guys are talking about, where my payment is, $1,500 a month, and anything I replace it with, it's going to double or triple my payment now. But what allows these guys also to do is prices are up. It's like, despite all the negativity and all the craziness, I mean, prices are still up.
Good point.
Up on, building on 20%, 15% last couple year appreciation. I mean, double-digit growth, which that doesn't really happen in real estate too often. No one's ceded any ground. No one's had their value kind of unwind. And so that, when you guys talk about this, when I'm listening, it's like, going to be a lot of sellers, I think, that enter the market if rates come down into the fives like you're talking.
Did the survey say what they were unhappy with or what they regretted?
It was a few months ago when I read through the article, it was things like they didn't do home inspections, or they settled for a house because they got outbid on different ones. It was a variety of things, from neighborhood to, like I said, no inspections, spending too much on appraisal coverage. There's people were going wild, to get into houses, and so I'll have to pull that article. It'll be a good one to share. Maybe we can put the link in the description below.
I wanted to ask real quick, Rich, about the stock market. Seems to be loving the news from yesterday. The bond market, not so much. Can you talk a little bit about the disconnect between the two?
Yeah, the long end of the bond market is not doing as well this morning as the short end. So what we have is people, or the market rather, believes that the Fed will lower rates once or twice more over the next 6 months or so. We'll see a couple more Fed lowering, but the market, I think, is saying we don't believe this is going to be a long-term lowering of interest rates, a 2 or 3 year cycle. It might just be a 6-month cycle. So we're seeing shorter term Treasury yields going down, but the yields on longer term, 10 and 30 year yields, are going up for that reason. The stock market loves it because they're seeing stimulus to the economy. It's going to help companies' borrowing power and whatnot. So they're liking the lower rates. It's free candy from the Fed, basically, for the stock market in the short term. Whether people stay in the market is another story, but there is a little bit of a disconnect right now between stocks and bonds. Yes.
Yeah, I just think that my perception has always been, when the stock market's kind of on fire, the bonds are losing money as people pull money out of safe haven bond, put it into the stock because they can get a better return on their investment. And when things are going south with the stock market, people are selling off stocks and putting their money back into the bond market, again, where you're guaranteed, even if you're only guaranteed 1% or 2%, you're at least not losing money in a down cycle on the stock market. Is that perception
That's historically true, but what we've seen since about 2010 is that the stock market loves the free money the Fed's handing out. The free money is helping large corporations to fund their projects and grow, and the stock market has loved that free candy. So where I used to see back in the 80s and 90s that they would move separately, like you said, the bonds went up, stocks went down, stocks went up, bonds went down. We've kind of seen over the last, I don't know, maybe since 2010, where both of them are kind of rising together. It's kind of an odd phenomenon, and I believe. I'm not enough of an economist to explain the nuts and bolts behind all of that, but we have seen a little bit of a disjointed movement where they move together. Now, this morning we're seeing stock market way up, low-end Treasury yields down, so we're seeing those two moving lockstep. But as I said, the longer-term Treasury yields are going up this morning, and the longer-term Treasury yields are what mortgages are derived from, the 10 and 30-year notes, and that's why mortgages are slightly up this morning because of that.
All right. Now, if you're like me, instead of moving money back and forth from bonds to stocks, you're going to buy gold and buy property. Real estate is honestly one of your best hedges. And so it's something really to think about, especially when you can lock in. You guys I don't know if it came up in the video. I think it did. The historical rate's around 7%. So it's like, it's really not a bad time to get yourself married to a nice piece of land somewhere before prices triple again in the next boom bust cycle. So, yeah. The one thing that I find interesting about all this, guys, is I don't know that it really matters what rates did today, if they go up or down. The perception in the public, and that's realtors, everybody, rates got cut, rates are down. I expect buyers to enter the market right now, and they're not going to really even realize that they could have locked in a better rate maybe a couple days ago. So I think that the perception is rates are coming down, and I'm forecasted they're going to keep coming down. So things should be good in real estate for both Rich doing refis and new buyers coming in, and for us helping sellers and buyers. And if you need help, call us. We're here to help. Our information's on the screen. Be sure to leave a comment, like, and subscribe anywhere in Ohio. I think Rich does Florida too, probably does all over the world. If you need help, even if you're out of state, call us. We're problem solvers. Happy to give you guys advice. Anything you guys need, just give us a message. Thanks for watching. Have a good day, and we'll see you next week with another update on the end of the economy.